The August PCE inflation report was released this morning. As you can see in this chart, this column shows you the actual release data, and this is the economist forecast, and this column shows you the previous data in the previous month. As we can see, the core PCE month over month is up 0.1%, cooler than expected 0.2%, and the year-over-year core PCE up 2.7%, in line with the 2.7% expected, and the year-over-year overall PCE up 2.2%, cooler than expected 2.3%, and the PCE overall month over month is up 0.1%, cooler than the 0.2% expected by the economist. This chart shows you the year-over-year change for the core and overall PCE. As you can see, in the green line represent the core PCE. It went up from 2.6% up to 2.7% in August. It's rising a little bit, but again, it was in line with the economist. And the blue line represent the overall PCE. It went downwards, right? The blue line went downwards from the previous month reported 2.5% down to this newly reported 2.2%, so cooler than previous month, and of course cooler than economist consensus. So overall, this report is definitely a cooler report as an inflation report, because every aspect they're either cooler than expected or in line with the expectation. Nothing is hotter than the expectation. So this report is reinforcing the decision of the Federal Reserve to continue the easing cycle. And after the report release, of course, we need to observe the market expectation on the Fed funds futures or Fed funds rate. And this chart shows you the Fed funds futures derived probability of how the interest rate is going to move. It shows that the probability of cutting another 0.5% or 50 basis point in the next meeting, which is scheduled to have the decision released on November 7th, right? That's the next FOMC meeting, is at 52%. So 52% chance to cut another half of a percentage in the next meeting. And the probability of only cutting 0.25 is at 47.9 or 48%. Okay, so it's more likely than not to do another jumbo size cut. Okay, big step cut. And of course, this sort of expectation on further easing or further aggressive easing will be reflected on the short-term treasury yield, and this chart shows you just that, right? This chart is coming from one of the latest research from Bank of America, and it's pretty macro. It shows you the difference between Fed funds rate in here, light blue color, versus the dark blue color 2-year treasury yield. Okay, 2-year treasury yield, and the difference between the two, right? Using the 2-year treasury yield minus the Fed funds rate, the difference is showing orange. Okay, so the chart is pretty much telling us that we're right over here, right? Today we're right over here. You can see the orange stuff, right? This chart is telling us that when the difference between the two, in this case Fed funds rate and 2-year treasury yield, that goes negative. Historically speaking, it has led to recession, right? Because if you look at, that's the COVID, right? You have the orange stuff go negative, and then the recession hits, and then you have your light blue line being forced to be pulled down to the floor, right? Because of the recession. Same over here, the great financial crisis, right? You have this negativity going on the orange line, the difference between the two, and then you get followed by a very bad recession, and then you can also observe that in the tech bubble, right? Have a negative orange region, and then the thing goes down, the Fed funds rate. So right now, one thing to observe is we are very low on this thing, on the orange, on the difference between the two things mentioned here. So this phenomenon happens because of how the 2-year treasury yield have a element of expectation on there, but on the other hand, the Fed funds rate doesn't. Okay, and this is how they can have the difference between the two is can be a recession indicator, and when the 2-year treasury yield is below the Fed funds rate by a lot, it's showing that the market is expecting an economic downturn. Okay, and this chart is actually linked back to the previous chart where I showed you the market right now is expecting another big size 50 basis point cut in November meeting. Okay, right now with a probability of 52%. So maybe the fear of the market uncertainty is driving the sentiment lower towards growth-oriented sectors such as information technology. U.S. tech negativity can be seen by the institutional investors. Here, this chart was shared by Goldman Sachs in one of their latest flow reports, representing their prime brokerage service. So it's representing the flows of their institutional investor clients. And as we can see on the left-hand side, this shows you, again, it's this information technology sector. It shows you the long and short ratio that's happening over here. As we can see, since 2021, there has been a huge decline, right? Huge decline in the long to short ratio. And again, in 2024, it didn't get any better. Right? We're still at actually the lowest point since 2015, that's 10 years ago. And 2024, again, another decline over here. Okay, long short ratio. Not saying that they're shorting more than the long position. Just the long position compared to their short position is getting weaker and weaker. Okay, and on the right hand side, we have underweight of the U.S. technology sector in their portfolio, the U.S. part of their portfolio versus the technology sector in the SPX, which is S&P 500 weighting. Okay, and as we can see, it's underweight, right? Underweight. The U.S. technology sector is like 17% underweight compared to the portfolio weighting of the S&P 500, or the weighting of the tech sector in the S&P 500. It just shows you that there's a lot of negativity going on, right? Again, for this chart, underweight of this sector is also at the lowest point, at least for 10 years, right? This is data from 2015. Both are at the lowest level in the past 10 years. So the sentiment for this sector, right, the most loved, the most popular sector right now among institutional investors, is very negative. And this chart shows you the prime book percentage of total U.S. net exposure for the Magnificent Seven stocks, right? Magnificent Seven, as we know, it's the 7 largest technology-related stocks, right? And as we can see, the net allocation to these we call mega cap technology stocks has fallen sharply in the past few months, right? The green shaded area over here is 2014, right? This year, as we can see in the past couple months, Magnificent Seven allocation, right, has been going downwards, right? So current level is at pretty much the same level as the start of the year 2024. So it's telling us that the institutional investors are starting to lower their concentration on the large cap technology stocks. Okay, thank you very much.